Hey, everybody, we are going to talk about some ETFs today, but some that you might not be too familiar with. I know everyone is tired of me pitching things like the VNQ real estate ETF and telling you to buy this Vanguard small cap ETF, but we're going to go a little bit beyond that. I'm joined by one of my favorite fools, Lou Whiteman. Before we dive in, please check out fool.com/Frankel. The link you see on your screen right now, you can get the top 10 stocks from the Motley Fool. It's the best way to support this work we're doing here on YouTube. Again, that link is fool.com/Frankel. So I challenged Lou today to kind of think outside the box, or maybe he even challenged me. Maybe I wanted to bring one of the boring ones to the table, if we're being totally honest. But so we're going to talk about some ETFs that we think could be big winners over the next few years that you might not have heard of yet. So Lou, we'll start with you. What do you have your eye on?
Well, first of all, I need to hijack the show and say, to your point, there's nothing wrong with just buying the Vanguard Index ETFs, fools. Or most of us, I mean, we're going to be better off for doing that. But yeah, no, it is fun to look around. And the one that kind of caught my eye, full disclosure, I met this guy years ago, so I might be a little biased, but CWS, it's Crossing Wall Street. And the story here is this is an ETF based on a newsletter that ran even before the days of the internet. A guy named Eddie Efferbein started writing a column about his investment philosophy, and it turned into a portfolio. And the kind of shtick here, or the thing, and he still uses it with the ETF, is there are 25 stocks in this portfolio, only 25. He can only switch out stocks once a year, and he can only switch 5. So it is basically a bet on the long term. Okay. The ETF has been around since about 2016. Full disclosure, it's basically matched the S&P 500. It hasn't really beaten it. But what do you get here? You get that long-term focused mindset where even if he wants to, he can only swap out 1/5 of his portfolio, and he can only do that once a year. You get a decent breakdown. About half of it's mid cap, and then 22% small cap, 33% large cap. You have a lot of just diversification. I think industrials is about 25-28% of the portfolio. That is the highest weight. The idea here is to find companies with strong moats, to find market positions, and just let them run, let the market do the work for it. Kind of back to my point on why index investing works, but just with a little bring going on. It is an active fund, which means you do pay higher expenses, but it's a 0.84% fee, so not a huge fee. One thing I love Eddie does is it's a fulcrum fee. I don't know if you're familiar with that, Matt, but if Eddie beats the market, or if he doesn't beat the market, the fees go down by 10 basis points the next year. If he beats the market, they go up by 10 basis points, but it's sort of a way to align the manager with your interests. So if he does not beat the market, you pay a little less. And again, just a version, kind of a hybrid between slow and steady. Don't think too much wins today, but you can find market winners and don't just have to buy the 500 best company in the S&P 500. So, a kind of a little bit of a blend of indexing, slow and patient, with putting a brain to it.
Nice. So I want to talk about one of the different real estate ETF. And first I want to tell you why. So I've generally talked about the VNQ, the Vanguard Real Estate ETF, which I own, and there's nothing wrong with investing in it. But there's a lot of pushback I get. One, it's a weighted index, and the largest REITs in the world are very heavily weighted, and they are all clustered in two different subsectors. You have the big tower REITs like American Tower and Crown Castle. Then you have the big data center REITs like Equinix and Digital Realty, and those make up something like 50% of the VNQ. Like, it's a big weighting. There's a big gap between them and other types of real estate stocks. So one that I'm looking at is the iShares Residential and Multi-Sector Real Estate ETF. Ticker symbol is REZ. So it's not just residential real estate. It also has healthcare REITs, it has self-storage REITs, and multifamily REITs. Kind of just what you would more think of as pure real estate. Most people don't think of cell towers when they think commercial real estate. Most people don't think data centers. That's more of an AI play right now, if you ask me. And a lot of those are looking like they're fully valued. I own Digital Realty Trust. It's done well, unlike most real estate stocks that have been very interest rate sensitive. So this one only invests in 38 different stocks right now. It specifically excludes data centers, tower REITs. It doesn't have any retail REITs if you're worried about retail exposure. It's just healthcare, self-storage, multifamily, and some like single family housing, things like that. Top holdings are, what you would expect because it is a weighted index. So the leaders in each of those categories make up a lot of the ETF. Like Welltower is the number one holding. Public Storage is the leading self-storage operator. So that's the number two holding, followed by Extra Space Storage, another big operator. Avalon Bay and Equity Residential are the two big residential REITs, so they round out the top five. Um, it's a really good option if you want real estate, and this one pays over 5% yield, by the way. If you want real estate, the kind of income that comes with it, and you think that real estate can benefit from falling interest rates over time, like I do, real estate is a very rate sensitive sector for a few reasons. I don't really want to get into all of them right now, but the general idea is these are yield focused instruments. As the yields on risk free instruments rise, it tends to put pressure on other yield focused instruments like REITs. Yield and price have an inverse relationship, so it puts pressure on their stock prices, pushes yields higher. And not only that, but REITs tend to use leverage, borrowed money to grow, and it makes it more expensive to borrow when rates are high. So, long story short, I think real estate will be the best performing sector in the market if interest rates do what they are expected to do. This could be a great way to play it without, investing all of your money in the usual suspects. Think of this as like a S&P 500 ETF that excluded the Magnificent Seven and excluded mega cap tech stocks. So this one has a 0.48% expense ratio, significantly higher than the Vanguard ETF charges, which you would expect. Not anything that I would call excessive, considering the specialization of it. So I really like this one over the next, next year or two. Um, so that's my pick right now.
The kind of the neat thing about that is, I think if you ask most people who look at like real estate, like what mega trends are going on and what should be avoided, the sectors that you listed, they're in and they're out. It's a pretty good way to sort of invest in important trends without like just everything in real estate and getting all that retail and kind of the more questionable, but multifamily, storage, the tower, the things, avoiding some of that stuff too. The things that probably are best suited in the conventional wisdom to kind of get exposure to those without buying individual names. That's a neat product.
Yeah, I like this one. I like the one you pitched a lot as well. These are I have to look more into that one because you just got that on my radar. So we're really living up to the headline here, REITs that you might not have heard of yet. But yeah, I mean, before we leave, real quick, I just want to ask you how you use ETFs in your portfolio, because personally, I've spent the first 10 years of my serious like investing career building a portfolio of individual stocks because that's what I enjoy. That's what I kind of believe in. I believe you can beat the market. And then in the past year or two, especially with the bear market, which gave me a nice little kick, um, kind of emphasize the importance of having like a backbone to your portfolio. So pretty much all the new money I've put into the market in the past couple of years has gone the index route. So I'm curious as to how you approach where do ETFs fit in your portfolio overall?
So for most of my 30 something years, or a good portion of them that I've been working, I couldn't buy individual stocks, which what that translates to is that retirement accounts and like what I was doing, I have a huge foundation of mostly mutual funds because most of that was before the ETF revolution. But so that is sort of the bedrock, and that should be, knock on wood, maybe not the retirement I want, but the retirement that would get me by. I personally haven't used a lot of ETF since, just because kind of the last few years it's been collecting stocks. As I kind of reach the next stage and slow down, I am looking more at buying kind of ETFs like the one, like some of these were just exposures to sectors, kind of in lieu of mutual funds, but it's not a huge part. I enjoy trying to figure out individual stock stories, and I still like that's where my focus is and where I put a lot of my money to, just right or wrong. But with the bad, knowing I have that bedrock there to kind of make mistakes, which ETFs and mutual funds, kind of feel interchangeable to me for that.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.